Hey, what's up guys? John here. In 2006 and 2007, it was a mania in the real estate market.
If you are watching us from the last home you'll ever own tonight, consider yourself lucky.
Real estate investors, realtors, mortgage lenders, they were making out like bandits. They were making a fortune.
How many loans do you write each month?
About 60.
Yeah. What was it 4 years ago?
10, maybe 15.
Yeah, I was a bartender. Now I own a boat.
Then, out of nowhere, the lights turned off. Now we're walking into something very, very similar. Newsweek just reported this morning that new homeowners across the U.S. are confronting a rapid depreciation in their home value, with recent data showing an average loss of $122,000, an average in home value in some areas. The American dream is showing signs of wear. This past year has seen an American household market shift, and property values are now in free fall. According to a November study issued by Point to Homes, owners who battled historic mortgage rates to purchase their homes are now facing a market in retreat as single-family homes shed up to $223 in value every single day. When you look at what's really going on in the housing market, what's happening in the U.S. economy, you are going to see that we're walking into the greatest transfer of wealth and assets that we've ever seen in American history. And in this video, I'm going to break it down for you and show you exactly what's going on. Please hit the like button. Hit the like button. YouTube will share this content to educate more people about what's happening in America's real estate market and economy. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item under credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session. If you're looking to invest during this great wealth transfer, you're going to want exceptional credit. Take a look at this. So, in 2022, a wave of over 5 million homes were sold in the U.S., with a quarter of these purchases made first-time home buyers. So, 1,250,000 of these properties purchased by first-time buyers. Average down payment, 6%. So you start to think about this. The average down payment is 6%, and if they were to buy a property and sell it the following day, paid a 5% realtor fee, plus transfer taxes and closing costs, escrow fees, they're underwater immediately. So you think about this. All these home buyers thinking they're going to marry the house and date the rate, well, they're walking into a rude awakening, unfortunately. Some of these new entrants to home ownership now find themselves underwater as the market value of their homes recedes. 15 largest markets in the U.S. are most affected year-over-year basis, according to Point to Homes. For both single-family homes and condos, single-family homes in Memphis, Tennessee, saw drawdowns of 17.1%, while homes in Chandler, Arizona, saw a more modest loss of 0.6%, but still ranked in the most affected category. The ripple effect of losses are potent enough to threaten homeowners. With negative equity, the report said a precarious financial position that turns the asset of homeowners into a liability. Now let's look at where these homeowners really are, because a lot of people have a false sense of reality of how much equity they have in their homes, because they look on Zillow and say, hey, home values are still high in my neighborhood. But what they don't realize is that right now, many sellers are starting to say, maybe I'm just going to cut it a little bit. I'll cut the price just a little bit. I'm still going to ask a big number, but I'll cut the price a little bit, and we'll see if I get some nibbles on this deal, or someone wants to run in here and make me an offer. But now, homes are unaffordable in 99% of the nation for the average American, and it's 52% more expensive to buy than it is to rent. So as the economy continues to change, some of these sellers are going to become more motivated. And when they have a small pool of buyers out there actually looking to pull the trigger, what's going to happen? Right? More distress is going to become more obvious. Look at what's happening right now with 30-year fixed rate mortgage on an average, right? This right here starting to skyrocket. You start to look at home ownership rates. You start to look at what's happening with consumers. You start to look at what's going on with the U.S. economy around mortgage rates and borrowing costs. You're going to start to see people just simply are not going to opt in to buy, unfortunately, at these prices for if you're a home seller. So, 8.114% for the average credit score in America, which is 698. If you're selling a property around $450,000, it's about a $4,000 monthly payment. $4,000 monthly payment. And so when mortgage rates are 3%, you're looking at $2,500. That's manageable. That's affordable for most people. If you have two incomes in your home, you could probably swing that. But as insurance and taxes continue to rise, it gets more and more difficult to manage these properties. And so when we look back at what happened in 2008, the CNN reported this. February 7th, 2008, homeowners can't pay, just walk away. More and more borrowers are watching their home values sink while the cost of their loan skyrockets. Well, in this case, many of these loans are 2.5%, 3%, 4%, 30-year fixed. But what's skyrocketing is not the mortgage. It's the insurance, the taxes, the food costs, utility bills, the upkeep on the property. Everything else around it is skyrocketing, which is indirectly impacting their debt-to-income ratio and their ability to pay these mortgages. And so when you start to look at where values are, I mean, there's a gentleman here talking about, he purchased a property in Hancock Park, 2 properties, and these 2 properties collectively were for $1 million. Hancock Park is near downtown LA. These homes are, $1 million, $2 million, all the way on up to $5, $10, $15, $20 million properties. And he said, he's got to walk away from this property. And so he ended up walking away and giving the keys back. This lady right here, Duane LeGrand, said she bought a 2-bedroom condo for $340,000. The mortgage balance $380,000. She can't refinance it, and it's difficult to sell because she's underwater on the property. When you don't have equity in your property, you have to sell the property and come out of pocket, write a check, or give the keys back to the bank if you can't manage it. When you look at what's happening right here, comparing us now to 2008, some people say that's an extreme example, John. There's no way we're going back to 2008. Did you know in 2007, at the height of the real estate market, the median home price in America was only $246,000? $246,000. The median home price today is $412,000, so nearly doubled. But if you look at where median household income in 2006, 2007, right at the height, was $68,610. Now you're looking at $74,000, right? So an increase in income at about $6,000, about $500 per month. But then when you look at how much extra food costs, everything else has increased dramatically. You can start to see that consumers are really being pushed to the brink. Here's a good example of this. A used car today is $34,000, $34,000 to $35,000. A used car in 2007, in 2006 was $8,000. In 2007, right for the pop, it was $8,100. So you could basically buy 5 used cars for the price of a used car today, right? That's where we are. We're walking into this very, very peculiar situation where in 2021 and 2022, there's so much money being put into the economy, everyone's afraid of inflation. They were borrowing as much money as possible, buying hard real assets. Now that's a great thing usually, to buy as many hard real assets as possible. But the key is being able to hold on when things start to get a little bit volatile. A lot of people are extremely leveraged, and a lot of people will not be able to hold on, and it's already showing that quite clearly. It's not just these 15 markets that were hit. Looking at the top 100 markets in the U.S., Point 2 analysts charted smaller year-over-year price drops that deflated values in 36 cities for condo owners and 25 for those with single-family homes. By dollar amount, the analyst said that deflation is the most evident in San Francisco, where condos lost $122,500 in value over the last year, a number that echoes the city's median income of $126,000. Markets that once seemed immune to buckling as well, New York City's boroughs, long touted for their resilience, are seeing values slip in both condos and single-family homes. In Manhattan, condo owners face the prospect of selling for nearly $70,000 less than last year's purchase price. In the Bronx, homeowners would sell for nearly $40,000 less than last year's purchase price. However, for those looking to buy a home, now may be a good time. That's what they say. They say now may be a good time. I would argue that you wait a little bit. You wait a little bit. Student loans are going to start to really weigh in on consumers. A lot of people with student loans own homes, and they were buying these properties thinking that everything was going to get forgiven. Well, as student loans start to come due, credit card interest rates continue to soar, the cost to borrow money continues to soar, small businesses continue to get pushed further and further and further, you're going to see people being forced to sell off assets. And if you can rent right now for 52% less than the cost to buy, it probably makes more sense to accumulate as much capital and cash as you possibly can. Put yourself in a position financially where you have really, really strong income coming in. So when you start to see distress, you can go out there and you can pick up one deal after the next, and put yourself in a really, really big position. If you look at 2009, 2010, many people went out there and picked up a lot of deals at peak fear. Right now, many people think, oh, this is a good time to buy. This might be it. This might be it. Wait till everyone is saying real estate is a horrible investment. You go see your family on Christmas for the holidays. You go see them and they tell you don't buy a home. That's ridiculous. Don't do that. That's when you know you want to buy. When you hop in an Uber and they're telling you you want to be a home flipper, probably not the time to be a home flipper, right? Wait until there's real panic. And I believe we're walking into a situation over the next 3 to 6 months where you're going to start seeing more people every month, month after month, thinking that real estate is a bad investment. You just wait a little bit. Wait until you find that incredible opportunity. If you find an incredible opportunity today, then go out there and buy it. Go out there and buy it. But to buy an average median price home, an okay deal in a certain area at these home prices with these mortgage rates, I wouldn't do it. I'd wait for an incredible opportunity, because your first real estate deal needs to be a vehicle. It needs to drive you from point A to point B. It needs to build wealth for you so you can take that money, you can throw it into the second deal. And then take money from the second deal, throw it into the third deal. And you have money and leverage to be able to move from one deal to the next. But if you go and buy and overspend on your first deal and put yourself in a really bad position in the first deal, it's hard to recover to do well in the second one. What do you think about this? Drop below, hit the like button. If you'd like to fix your credit to position yourself for the greatest wealth transfer in American history, we'd love to help fix your credit at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, a negative item on a credit report, go to GreatCreditFast.com, click the link in the description below this video, schedule a free strategy session. Catch you in the next video.